Interest rate cuts. Are they really the financial lifesaver everyone thinks they are? Most people believe lower rates mean more money in their pockets, but here's the truth. These cuts can sometimes hurt your finances more than help. Today, we're busting the top 3 myths about interest rate cuts you absolutely need to know. Stay tuned. Myth number 2 might completely change how you think about investing. Alright, let's dive right into the first myth. Lower interest rates always mean borrowers come out on top. This is a common belief, but it's not always the full story. Now, on the surface, this seems pretty logical, right? Lower interest rates should mean that borrowing money becomes cheaper, making it easier for people to afford big-ticket items. Lower rates mean lower monthly payments on things like mortgages and car loans. This can be a huge relief for many families, allowing them to stretch their budgets further and potentially save more money in the short term. Sounds like a win-win, but hold on a second. It's important to look beyond the immediate benefits and consider the broader implications. What most people don't realize is that banks are playing a long game. They have strategies in place to ensure they remain profitable, regardless of the interest rate environment. They're not just going to hand out free money because rates are down. Banks will always find ways to protect their bottom line. They'll find ways to offset those cuts, often by hitting you with higher fees or making the lending requirements way stricter. This means that while you might get a lower interest rate, you could end up paying more in other areas. Suddenly, that amazing low-interest loan doesn't look so hot anymore. The additional fees and stricter requirements can quickly erode any savings you thought you were getting. And let's not forget about those adjustable-rate loans. These can be particularly tricky. Sure, you might snag a sweet introductory rate for the first few years, but what happens when those rates inevitably climb back up? This can lead to a significant increase in your monthly payments. Your monthly payments could skyrocket, leaving you in a much worse position than before. This is a risk that many borrowers don't fully appreciate until it's too late. The bottom line is this: don't fall into the trap of thinking every interest rate cut is automatically a good deal for you as a borrower. It's crucial to look at the whole picture. Do your research, read the fine print, and make sure you're not getting played by hidden costs or future payment shocks. Always consider the long-term implications of any loan or financial product you take on. By being informed and cautious, you can make better financial decisions that truly benefit you in the long run. Remember, financial institutions are in the business of making money. They have teams of experts working to ensure their profitability, so it's up to you to protect your own financial interests. Educate yourself about the terms and conditions of any loan you're considering. Understand the potential risks and rewards, and don't be afraid to ask questions or seek professional advice. By taking these steps, you can navigate the complexities of borrowing and make choices that are truly in your best interest. So, the next time you hear about an interest rate cut, remember to look beyond the headlines and dig deeper into what it really means for you. Now, let's move on to myth number 2, and this one's a big one. The idea that lower interest rates are some kind of magic elixir for all investments. This myth is pervasive, and it's easy to see why. The notion that lower rates automatically translate to higher returns is appealing, but it's also overly simplistic. You'll often hear people say, lower rates mean more money flowing into the market, which means higher stock prices. This statement is frequently echoed by financial pundits and analysts, and it can be tempting to take it at face value. And yeah, in the short term, that can be true. Rate cuts often lead to a temporary boost in the market. Investors get excited, and the influx of capital can drive stock prices up. This initial surge can create a sense of euphoria, making it seem like the market is on an unstoppable upward trajectory. But here's the catch: those cuts can be a sign of bigger problems brewing beneath the surface. When central banks decide to cut rates, it's often a response to underlying economic weaknesses. These weaknesses might not be immediately apparent, but they can manifest in various ways over time. Think about it. Why do central banks cut rates in the first place? Often it's because they're trying to stimulate a sluggish economy. A sluggish economy can be a precursor to a full-blown recession. Central banks use rate cuts as a tool to encourage borrowing and spending, hoping to jumpstart economic activity. And let's not forget about the impact on specific sectors. When rates drop, financial institutions like banks tend to feel the squeeze. Lower interest rates mean lower profit margins on loans, which can significantly impact their bottom line. Their profit margins on loans shrink, which can hurt their bottom line and send their stock prices tumbling. This is particularly concerning for investors who have a significant portion of their portfolio invested in financial stocks. So, if a big chunk of your portfolio is parked in financials, those rate cuts might actually be doing you more harm than good. It's essential to understand that not all sectors benefit equally from lower rates. While some industries might thrive, others could struggle. The key takeaway here is that interest rate cuts are not some guaranteed recipe for investment success. They're a complex economic tool with far-reaching consequences. Understanding those consequences is crucial for making smart investment decisions. They're a complex economic tool with far-reaching consequences, and understanding those consequences is crucial for making smart investment decisions. It's not just about the immediate impact on stock prices, it's about the broader economic context and how different sectors are affected. Don't just blindly follow the hype. Do your due diligence, diversify your portfolio, and make sure your investment strategy aligns with your long-term goals. Diversification is key to managing risk, especially in a volatile economic environment. By spreading your investments across various sectors and asset classes, you can better protect yourself from the adverse effects of rate cuts and other economic shifts. Remember, the financial landscape is ever-changing, and what works today might not work tomorrow. Stay informed, stay flexible, and always be prepared to adjust your strategy as needed. Lower interest rates can offer opportunities, but they also come with risks. By understanding both, you can make more informed decisions and navigate the complexities of the market with greater confidence. Alright, let's wrap things up with myth number 3. The belief that your savings are untouchable during periods of interest rate cuts. This is a common misconception that many people hold, thinking that as long as their money is in a savings account, it's completely safe and unaffected by the broader economic environment. This one's a classic case of out of sight, out of mind. People often don't realize that the financial landscape is constantly shifting, and what seems secure today might not be as safe tomorrow. It's easy to assume that because your money is in a bank, it's shielded from any economic downturns or policy changes. People see their money sitting safely in their savings accounts and figure it's immune to the fluctuations of the market. They look at their account balance and feel a sense of security, thinking that as long as the number isn't going down, their wealth is preserved. But this is a dangerous illusion. But here's the cold, hard truth. Low interest rates are brutal for savers. When the central bank cuts interest rates, it affects the returns on savings accounts and other low-risk investments. This means that the interest you earn on your savings can drop significantly, sometimes to the point where it's almost negligible. When rates plummet, so do the returns on traditional savings accounts and certificates of deposit. This can be particularly frustrating for those who rely on interest income, such as retirees. They might find that their expected income from savings is much lower than anticipated, forcing them to dip into their principal or seek riskier investments. You're essentially earning next to nothing on your money, and that's before we even factor in inflation. Inflation is the silent thief that erodes the purchasing power of your money over time. Even if your savings account is earning some interest, if that interest rate is lower than the inflation rate, your money is effectively losing value. See, inflation is this silent wealth killer that eats away at the purchasing power of your money over time. It's not just about the numbers in your account, it's about what those numbers can actually buy. As prices rise, the real value of your savings diminishes, making it harder to maintain your standard of living. When inflation is higher than the interest you're earning, your savings are actually losing value. This is a harsh reality that many people overlook. They see their account balance staying the same or growing slightly and think they're doing fine, but in reality, their purchasing power is shrinking. It's like running on a treadmill. You're putting in the effort, but you're not actually getting anywhere. So, what's the solution? How can you protect your savings from the dual threats of low interest rates and inflation? Well, you can't just stuff your cash under the mattress and hope for the best. That might have worked in the old days, but in today's economy, it's a surefire way to lose money. You need to be proactive and strategic about how you manage your savings. You need a proactive strategy to protect and grow your wealth, even in a low interest rate environment. This means staying informed about economic trends and being willing to adjust your financial plans as needed. Consulting with a financial advisor can be incredibly helpful in navigating these challenges. That means exploring options beyond the traditional savings account. There are several alternatives that can offer better returns without taking on too much risk. For example, high-yield savings accounts often provide higher interest rates than standard savings accounts. making them a more attractive option for savers. Things like high-yield savings accounts, money market accounts, or even short-term bonds. These options can provide better returns while still offering a level of security. It's all about finding the right balance between risk and reward to ensure your savings grow over time. So there you have it. 3 major misunderstandings about interest rate cuts. It's not all bad news, but understanding the hidden risks can save you from financial mistakes. Which myth surprised you the most? Let me know in the comments. And if you found this video helpful, don't forget to like, subscribe, and share with someone who needs to know these truths. Knowledge is power, especially when it comes to your money.